Hello, everybody. Welcome back to the channel. My name's Max Convexity. I have a really special guest here with me today, and we're just going to do it live. Last time I talked to Howard, I recorded it, but you guys probably know this man. He's pretty famous in the option trading community. His name's Howard Chan. I'll let him tell us a little bit about himself. Howard?
Hi, Max. Great to be here again. So I'm the CEO of Kurv Investment Management, and we are our mission is to make available institutional grade strategies to investors of all sizes, and we focus particularly on things that make strategies more tax efficient. Usually, we use derivatives such as options in our strategies, and lastly, we generally have cross asset classes in our strategies to generate what we think would be better performances that can navigate all different markets.
Howard, could you give me a definition of cross asset class? Explain how that works, how you use those.
Sure. So maybe your audiences are familiar with our existing cover call ETFs, the yield premium ETFs. In that fund, we are generating income by writing cover calls on a long technology exposure, right? So writing the calls uses options. That's sort of one asset class. The underlying long exposure, we can either buy stock, which is one asset class, or we can do a synthetic long, which is by buying a call and selling a put of the same strike that uses 5% of the capital in the fund, and the remaining 95% we can invest in T-bills, which is fixed income. So in this case, our strategy actually crosses three different asset classes, and for each one of those asset classes, we're able to kind of generate a different sort of income. So for the options, we are generating option premium. The long exposure is trying to get exposures to that stock. And the T-bill, we can get some interest payment from the T-bill, which is right now with almost no risk, 3-month T-bill. It's a U.S. government obligation. You can yield, 5.25% from cash. Yeah.
Absolutely. Absolutely. Okay. Well, I understand now. Now I appreciate you explaining that. Now let me ask you this much. Okay. So you've come out with the new fund, and that's the main reason I have you here today. I'm super excited about the new fund, but at the same time, I want to talk some about your strategies generally also. So now you mentioned that you have a suite right now of 6 ETFs that you call your yield premium, and those are designed to gather income, right?
Yeah.
Okay, but your new fund has different wording in the prospectus. It doesn't say it's actually going for total return. What kind of threw me off though is you've also said that you might use your old ETFs and put them in your new fund, but they have different goals. How's that going to jive? Or am I missing something?
No, you're not missing something. And maybe here is worth a little bit of an origin story about the new fund, which is the ticker is KQQ. It's our Tech Titans ETF that we just launched. Since the firm started and we launched the first 6 covered call ETFs, we've always had the same question every time we did an investor call, which is, are you going to launch a fund of funds?
Yeah.
We designed the first 6 as tactical tools for investors to, put on the exposure and then also exit the exposure relatively easy if you just had a brokerage account. But they were always meant for, we want the investor to make decisions what tech names they want to have in their portfolios, right? And so through the first few months, even when we launched it, many investors said, I don't necessarily want to make the choice. The market moves quickly, so we want to delegate that choice, right? And so we went really to the drawing board and thought, how can we create a product that we want ourselves in our own portfolios? And I know there are other products that basically mix the different cover calls in a basket, and people invest that way. But we really thought about kind of how we would design the exposure in the portfolio. So we went back and we said, first of all, what kind of strategic exposure? So now instead of being tactical tools, people are looking at this as sort of a more core holding in their portfolios. So
Exactly.
we did a lot of actually research. Most of the stuff that we do has to be backed by evidence and research. So we went back actually 20 years of history, and we looked to actually a particular segment has actually outperformed the general NASDAQ tech basket. Is the larger names in technology has outperformed the broad market. Now,
Yes.
year to date, there's a lot of talk about, the market has been driven by 7 names, and then they compare it with, S&P, what's the bottom 493 names is doing, et cetera, right? But this is sort of a news thing that happened this year. So we went back in history. We actually seen that the largest 15 names in the market, we use NASDAQ sort of as a proxy, and I'll kind of describe why there's an issue with that. But looking at NASDAQ top 15 versus NASDAQ 100, which is a broad benchmark, we've actually seen for the last 15 years, there's been a very persistent outperformance by the largest names. And there's many theories about that, but for us, the reason is a lot of these large names are very familiar names that everybody knows, right? Apple, Google, these are really involved in all parts of our lives. And all of these companies have something in similar, which is they have a pricing advantage in the market. They're also very dominant in their particular verticals. And this basket, although will change from time to time, these technology companies generally continue to grow, right? Like, I think the common intuition is that the larger the company is, the slower the growth is, because they're a much larger part of the market. There's not enough room for them to grow, right? But these names actually defy that intuition, that they continue to grow for the last 15 to 20 years. And even within the last four or 5 years, you could actually do this calculation yourself. The top 15 names have actually outperformed the market by almost 4% every year. The one exception is in 2022, there was a political instability. We had a war, but the following year, it outperformed by 12%. So there was a rebound. And that difference has only become bigger in recent years.
Yeah.
So that's how we decided the secular exposure, which is things that you want to hold in your portfolio for 3 to 5 years. We wanted to do a basket of some of the largest technology names in the market.
Perfect. So, okay, but now I read the prospectus, and the way I kind of understand the prospectus, it looks like you're going to almost have 2 different books. You're going to have some growth stocks, but then you're also going to have a different set of stocks to write calls on. Is that correct?
Yeah. So what we wanted to do is to actually address, I guess, a philosophical thing in my mind with cover calls. As you know, since 2022, there's been a slew of lots of cover calls, ETFs that's been issued in the market, right?
Sure.
And a thing that bugged me, and I think an illustrative example is like, would you want to write cover calls on NVIDIA this year?
Not with the benefit of hindsight, I wouldn't, but yeah.
Right. But a behavior of a lot of tech stock is that they tend to have these really swings in momentum, right?
Well, true. Yeah.
Right. And so and this is actually the second step in our portfolio construction process, once we've picked the basket, which is that tech stocks generally are growth stocks, and growth stocks have momentum. And what that means is that if they show price appreciation, they will tend to have more price appreciation until there's a pivot point.
Yeah, no, I agree. I agree. I like that. I'm a momentum. I mean, this is exactly how I would do it if I was doing it. Yeah, so I agree.
So once we've determined our set of 15 to 20, by the way, we reassess that every quarter. Okay. We actually do this momentum weighting. So we do it on 2 different scales. Some names that have short-term momentum, we start overweighting it by 2.5%. And then longer lag, we do another 2.5%. So the max overweight is 5%.
Okay.
And we basically overweight the names that have momentum to look to magnify the upside when it's going up.
Sure.
Right? In a traditional cover call strategy, you're capping that upside, right? So in an example I would say is like if Nvidia ran up 30% and you want 10% income, maybe a better choice is to let the stock run up 30% and sell 10% to get the income that you want, right? So you're not missing out that 20% of upside appreciation, right?
True.
So that is the first part that we're doing. So we're doing this dynamic weighting, but then not all names in the basket will have momentum, right?
Okay.
So the names that don't have momentum, we write cover calls. And that's actually the best scenario for cover calls, right? Because cover calls are great if the stock is either falling, which is negative price momentum, if it trades sideways, or it is steadily going up.
Yeah.
So that's the perfect use. If we were to use cover calls in our own portfolio, that's how we would do it. So then what happens is for the names in the basket that doesn't have momentum, we start writing cover calls to generate income.
Absolutely. I like that. I like that. So go ahead.
And there's actually a particularly interesting feature when you do it this way, which is that, there's a lot of debate in the market. Are we at a market high? Is there correction? Is this a sector rotation between tech and small cap and et cetera, right?
Yeah.
So in an environment, I think the premise that we come in is like, if you look at tech, there are always cycles of upward price appreciation, minor corrections, and another, right? So in the early 2010s, you have this productivity boom. A lot of tech stock went up, right? And then it corrected itself. In COVID, technology stuff did really well because there's this work from home mentality. We're never all going outside again. And then once things open up, there was a correction. And now there's like this AI boom that has next leg. And then maybe not we're in this correction, right? So if your premise is to accept that there's just these little corrections, how do you deal with that, right? So in our strategy, the interesting characteristics is that when there is a market correction, all of the names or most of the names in the basket won't have upwards price momentum, right?
Okay. Yeah.
So that means you start writing cover calls on all of the names to generate income in a falling market, and that cushions and mitigates the downside.
All right. And you guys will do that? You guys will.
That's the dynamic switching that will happen.
Okay. Perfect.
And then what's even better, as you know, your audience, who knows options, is in a market sell-off, implied vol increases.
Oh, yeah.
So you actually get more income during that environment to cushion the downside.
Yeah, but your NAV's getting punished at the same time. But yes, you're getting more income.
Your NAV's getting punished, but the premium would be actually more than if you had written, because the implied vol, the premium that you can generate also increases. The realized vol probably will go up also, but I think if you're pricing market uncertainty, there's more uncertainty in a falling market, right?
Yeah.
And so the way that we designed it was that this has a counter-cyclical feature in this basket of technology stocks. So the way that we thought about our product is, if you want steady, consistent income, the first 6, buy a basket of those, you can get the consistent income that you want.
Yeah.
And then if you want something that maybe you have FOMO or you want to capture some of the price upside, but you also don't want to tactically kind of go in and out in exposure, you have this downside mitigation mechanism. That's the KQQ. That's the exposure that you would have in your portfolio.
So, and you guys reallocate the 15 to 20 stocks once a quarter? Is that?
Once a quarter. And there's something a little bit special, and I alluded to this at the beginning of the call. We use like NASDAQ top 15 as a proxy, but it's actually, I don't know if most people, I think equate NASDAQ 100 as their technology exposure in their portfolio.
Sure.
But it's actually, if you look through the holdings, 20% is actually not technology related. Sure. And even in the top 15, there's names like Costco and Pepsi that are not technology based. So the first step in us is actually creating a pure basket. And we're not restricted by where the name is listed. We're looking at names that uses technology to enable their business, and we kind of defy categories. So for instance, Amazon, if you use a traditional financial categorization, would be considered a consumer discretionary company and be excluded from technology.
Yeah.
So even though they derive a lot of their revenue from AWS, right? So
Yeah, exactly.
yeah. So we include those names. And then there's other names like, for instance, Oracle, that's not listed on NASDAQ, that's on the New York Stock Exchange. We'll include those names too. So we're looking really holistically on a curated basket of technology names.
Of you big tech. You guys want big international tech, regardless of what exchange it's on, from what I'm hearing.
Yes, because they have pricing power and they're very market dominant in their verticals. Yeah.
Yeah, the multinational, the big boys. Okay, well, that's great. Let me ask you this. I want to go a different direction. You've mentioned before that you guys are really sensitive to taxes, and this is on all your funds, I assume.
Yeah. Yeah.
Okay, so this applies to the new one as well. Do you guys do something different that your competitors don't do, or is it all? I mean, is it the 1256? I mean, there's some standard things that everyone takes advantage of. Is that not right, or is there something additional and better that you do?
I think it is something. The tax code is the tax code, but I think there is a distinction that in terms of index options versus single name options. So there's a different tax treatment for index option premiums, the 60-40 tax, long-term, short-term.
Yeah.
And then there is the single name, which is more predisposed to return of capital if you distribute the premium correctly.
Yeah.
So I think the difference comes from the exposure that you choose, right? There's a lot of covered calls ETFs that are writing covered calls on indices, right?
Yes.
S&P, NASDAQ. They're utilizing a different tax treatment than the single names.
Right.
Yeah. And then I think it's worth mentioning also that there's other differences, which is maybe before last week, you've seen that the VIX actually reached kind of a 4-year low. So there's actually generally less volatility in the market, but that's on indices. So, the way VIX is constructed, the diversification of many names in an index reduces the volatility, that's inherent that you can, price in. But actually, single names still have pretty healthy premiums because obviously they're concentrated risk. So there's been a lot of talk about this basis trade, which you would long single name, a basket of single name, and then not short, but necessarily kind of do, short the sort of the spread between names and then the index.
Yeah.
And so it's kind of interesting. We've seen more people, instead of, getting the diversification from the index and then harvesting vol, a lot of people are harvesting the vol on single names and buying a basket of it to get the diversification. So the ordering is different, so they can get additional yield in their portfolios.
Exactly. And that's why I was interested in that. And that's what you guys have done on this latest one. So I guess with the single name, and you mentioned this in our first interview, I think it was you, there's some kind of straddle treatment or something they have in the tax code when you're trading single names. And there's some kind of advantage that these funds could use. But you're right, on the indexes, you get the 60-40 treatment. So I guess you get to take advantage of a rule either way. It just depends on how you allocate.
It's a different rule. Yeah. And I should probably clarify that the straddle rule is you can defer certain losses. We don't do that. We roll all of our longs at the same time. So the gains and the losses always kind of happen at the same time for our synthetic longs. But the advantage is that if we distribute beyond, a certain amount, some of the distribution are considered return of capital, which is not immediately taxable.
Sure.
It depends on your holding time of the underlying ETF.
Sure. Yeah. Sure. All right. Well, yeah, thanks for clearing that up. Okay. Well, back on KQQ, what kind of dividend do you guys think you're going to be able to pay on there? It doesn't even really say it doesn't say to pay an income really. I mean, are you going to pay a dividend?
We will on a monthly basis, but
Okay.
unlike the first 6, which is we try to keep it as consistent as possible, this one is more dynamic. So the range that we anticipate is between 4% to 11%. So obviously in upwards market, we let more of the price appreciation dominate instead of the income. So let me back up. So we're trying to optimize total return, right?
Yeah.
So there's generally there's 3 components, but for us, this is all US dollars. So there's 2 components. There's a price return and an income return.
Okay.
So when the market is going up, we let the price return dominate, and that we will still write cover calls. There's just not as many names that we're writing cover calls on because we don't want to cap the upside, right?
Sure.
So that would be around the 4% range in upwards market, trending markets. And then when there is a downward trending market, obviously the price return goes down or negative, and then we can actually write more cover calls on the net. So then the income component becomes much more important, and that can get us to the 11%. So if you split it halfway, that's about 7% through a market cycle is probably around the range that we're looking at. Yeah.
No, that's great, because I notice right now you only have a couple of calls written, and it's not for even very much money. And just based on that, you aren't going to be able to pay a very high dividend, but that you're fine with that because you might write some more here and there, but the market's going up. So I get it.
Yeah.
You don't want to cap any upside. Theoretically, if you knew the market was going to go up, you could theoretically just write no calls. Of course, you don't ever really know for sure, so you like to have some. But no, I love this strategy.
Yeah, we will always write some cover calls. Just the nature that not all names will be up, running up and have momentum. But the number of cover calls we write will really depend on the market. So we let the market speak to us. Yeah.
Yeah, well, it's going well so far. So how much assets under management do you have? I should have checked before I got on here, but I didn't. How is it growing? I mean, how has it been accepted?
Yeah, so we launched about a week ago. We've gotten $2.5 million inflows, and we actually know that there's additional 5 to 10 million that's coming in. Obviously, there's some market volatility, so people are trying to time the entry.
Sure.
But the trading has been extremely healthy. I think day one we had basically a million and a half come in, and every day since then we've had at least 5,000 to 10,000 shares that are trading. So it's been something that it's a good start. We're not going to end there, obviously, but I think it is a little bit also topical, right? Because the tech market, people are talking about sector rotations and all that stuff. But I think the reason why we built this to be a secular exposure is it's actually kind of expensive. When people say, oh, in a correction, you should trim some of your exposure, take some profit.
Yeah.
But that's kind of expensive if you think about it, because for my portfolio, and I think many people, we've held a lot of these names for a long time. And so the bases are very low. So if you sell it, you're going to have cap gains taxes, right?
Sure.
So for those who are just looking to get the exposure now, I think it's probably better to have a more dynamic strategy that can, mitigate downside and participate in the upside. One of the things that you could do with options is change the upside and downside and make the return a little bit asymmetric, right?
Yeah.
You want to magnify the upside and then lower the downside. That's what options are really great for, right?
Exactly. Yes.
And then the people who do have exposures, I think, transitioning over time to a more dynamic can, potentially save some tax bills, right? So, yeah.
No, yeah, absolutely. Well, let me ask you this, because I've asked other fund managers, what's the break even? I mean, I know you want to manage, you want your fund to grow to $1 billion or $10 billion, but what does it have to grow to be, other managers have said 20 or 30 million, but is there a limit like that where you need the darn thing to get to self-sustain it?
I think the range is right to cover the cost of the fund, right? But I think for this one, we're not too worried about it because this would be like kind of a core complement to like triple Q, right? Or like this is a larger portion of people's portfolios.
True.
So
Yeah.
I think that's definitely kind of very, doable for this fund.
Absolutely. Well, I got a good question here. I'm going to put it up on the screen. From Surf and Wine, it says, in your back testing, what did you learn that will allow you to develop a new type of ETF that you do not see in the marketplace currently? KQQ is a great addition. What are other potential areas? That's a good question.
Yes. So just to, give you some context. So I guess I'm an engineer by training for a long time. So we took a little bit of the tech approach. It's like we try to suss out what are problems in the market, and then we try to find a solution, right? So in this case, some of the problems are technology names don't distribute dividends or very little. So you want to have income in your technology sector, or else you'd be overweighting like utilities and energies and financials, which are like part of the sector, versus technology is the future of the economy, right?
Sure.
The second problem is, how do you not cap the upside in sudden growth situations for tech stocks, right? So we took these problems and we created a solution, that's the dynamic weighting that allows us to participate in both sides. So that's how we think about new products. I can't go into too much detail, but we have another product that we actually are very excited about that hopefully will come out soon. Is actually in our home turf, which is fixed income. A lot of us came from PIMCO. Is that there's been a big issue in the fixed income world. That the curve has been inverted for actually more than a year since we've had the rate hikes for last year to defend the inflation, right?
Yeah.
So in many cases in fixed income portfolios, they outperform because they either take term premium risk, duration risk, meaning the longer the bond you hold, the more you should compensate because you're taking on more risk, right?
Yes.
Or they take credit risk, which is if your debtor has non-zero chance of defaulting, versus a government, you should get compensated for that.
Yeah.
But they haven't been able to get additional yield from term premium because the yield curve has been inverted, meaning you're paying to get longer bonds. Doesn't make sense.
So you guys are coming out with the fixed income product.
A fixed income product that uses volatility in a way that I think will help people's portfolio in a different part of the portfolio. So we're really excited about that. We're just, we can't launch too many at once because then nobody will know about any of them. So we have to pace ourselves a little bit. Yeah.
Well, no, that's awesome. And I'm sure I'll have you, or hopefully I'll have you back on when that comes out. I like that kind of stuff too. Let me ask you this question though. So I like the plan on KQQ. The only criticism, or the only counter argument I could possibly come up with is, aren't you worried about recency bias? What's worked the past 20 years may not work the next 20 years.
Yes. So that is always the case. Can big technology companies continue to outperform? And I think there are some evidence that they potentially can. So whether you believe in this AI boom or not, so I'll give you a more topical reason, and then kind of, a more theoretical going into the future, right? So, we've talked, this year's hot topic, obviously, what's driven a lot of tech stocks is this discussion about artificial intelligence, right? And although there's some questions about whether these companies can actually translate this technology, AI boom, into profitability, we do know of certain things. These large language models really require two big things to be successful, right? One is they need to have a lot of compute, and compute are expensive. So you have NVIDIA, who's sort of the supplier of compute, and then you have the consumer of compute like Google, Microsoft, and Apple.
Okay.
Very few companies have the capital to buy compute. So
Yeah.
in some ways, they're the only ones in town that can actually continue to develop this technology. The second is they need a lot of training data, right? And a
Okay.
lot of these companies, these largest companies, are the only people who are in positions with huge amounts of training data. I would say Apple and Amazon are very well positioned for consumer training data. Microsoft is more business corporate training data, right? So
Sure.
they are in some ways best positioned for the future. And let's say even you think this is overblown, overpriced, like you're anticipating uh, um, the corrections, right? We're not fixing the basket, right? The basket is alive and dynamic. We reset it every quarter. The ones who will succeed and become bigger will come into the basket. So, this tech cycle is different than the same company that did the last one and the one
Yeah.
before. So we have built in enough dynamicism in the basket so we can always kind of capture the new technology advancement and growth in pricing, tech stocks.
Absolutely. No, I like your plan. I'm on your team. I was just trying to think of a counter argument, and that's the only one I could come up with. But
I
I
mean,
know what you mean. Yeah,
yeah, I
but it's
think
not
it's,
even. It's
it's
my argument's not even a great argument. Now that I'm thinking about it, it's a poor counter argument, but it's the only one I could come up with.
no, I mean, legitimately, I think even in industries that are, the way, and this is a very fine way of how we describe technology companies. You can look at it in our prospectus. We're not using the normal categorization that people use in financial industries. We're also looking at companies who are using technology to dominate their field. Like in a normal categorization, Netflix would not be considered a technology. It would be considered a media company, right?
Yeah,
But they have definitely effectively used technology as a more efficient way to distribute content, right? So
absolutely.
we're not kind of trapped in the traditional semiconductor software kind of company. We want to look at, if there's a medical company that's using AI to screen cancers much more effectively and it dominates the way that they generate revenue, that could be considered in a basket. So we want to be a little bit adaptive in terms of what we mean by tech.
Yeah, no, and I read the prospectus and the way you worded it, and it was great, and I get it, and I get what you're trying to do, and I think it's gonna be awesome, and I think this is going to be a different deal. A lot of these income funds, that's the whole deal. Is their whole goal is just to give you income. Well, this is a different fund. This is more of, like you say, more of a core holding, or that's what you're hoping it turns into for investors, people that could hold it and get their tech exposure and be comfortable that they would perform in an up market and then still have some cushion in a down market. I think it sounds great. I didn't understand that in a down market you're going to write options on all of but that's great. That's great. So now it just comes down to execution, right? How can you
That's right.
execute? So is that you or
Yeah.
is that the sub advisors? Who pulls the
Nope.
trigger on when to roll?
There's no sub advisors on this fund. We are
Ooh,
managing and buying and selling all of the options.
nice.
Yes. So I think a lot of people, maybe commentators in the market, saying, like this strategy is terrible when, and that strategy is terrible then, right?
Yeah.
Um, and I think there is a place depending on what your investment goal is, right? So like the first 6 is for those who are close to retirement or in retirement that want to supplement some of their income from they don't care about price appreciation. They just care about
Exactly.
consistency and income generation, right? And that's what we made those things to be for, is that we want to be, if you look at the distribution for those funds, we try to keep it almost consistently very, like almost the same every month, right?
Sure.
In
Sure.
fact, we think we actually could increase the distribution, but we're trying to making sure that any increases will also continue the consistent distribution.
I get
And
you.
then there's some that are not close to retirement that could use, more price appreciation, riding sort of the market, the growth of the economy. So, prices going up. And so that's another strategy for a different kind of investor. So we're trying to, meet different investment goals. Yeah.
Well, I know this is hard to say, but it's another question from a viewer. Do you see KQQ outperforming triple Qs, outperforming the NASDAQ?
Well, that is the goal.
Yeah.
I think one of the things, the reason why the first step is to try to find a curated basket is because we have some data, and actually you can go on our website. We wrote a research paper or a Q&A on this. Just by removing the non-technology exposures in the top names in KQ in triple Q, you can actually already improve your performance. And the reason is because Pepsi and Costco, they're great companies, but their price appreciation potential is slower.
Yeah.
So just removing those slower growing component, you already have an advantage over triple Q.
Yeah.
And then the dynamic weighting is the kind of the other things that we try to improve the performance. But the goal is to outperform a broad-based benchmark over a secular horizon. Yeah.
Yeah, and you should in theory, you should outperform on the way up, and then if everything works the way you say, and you sell calls on the way down, of course, that should give you a little cushion on the way down, and you won't do quite as bad. Yeah, exactly. That is awesome. Well, Howard, I appreciate you being on here today. We've about run out of time today, but I really appreciate you being on here. I'm looking forward to hearing about that income fund. I like those real stable option, as long as they sell options in some manner. I like any type of fund. There's some other bond funds out there that where the underlying is real stable and it's just T-bills and stuff, but they sell, about this, they sell options here and there and they make a little extra income. I assume you're going to do something like that, but who knows? I'll be anxious to see exactly how you do it though.
Yeah. Well, I definitely will be happy to come back and talk about that. I'm really excited about KQQ and that one, because those are sort of, again, like we built it on what we put in our own portfolios. So
yeah, I think it's going to be a good one, and it's my best performing video in a couple of months. Yeah, when I talked about KQQ, people were obviously really interested in it because the video wasn't that good. It was nothing I did. They were tuning in for the KQQ part. So anyway, I'm excited about it too, and I'll be watching it every day. And if I have any questions, I might just email you. If anyone on, because I can always, feel free to email you if I have a question before we have time to get together for our next interview.
Yeah, let us know. We're excited. We want people to know more about the strategy and how we thought about it, and most importantly, how we designed it. So, yep.
Well, absolutely, Howard. Well, thank you so much for being here today, and you have a wonderful day.
Great. You too. Thank you.
All right. Bye-bye.